This is a video for those who are currently Canadian citizens but working in the US. So here's a detailed step-by-step guide for rolling over your 401k or IRA into a Canadian RSP when you move back to Canada. So number 1, contact your US financial institution and request either a full lump sum or partial withdrawal. If under the age of 59 and a half years old, be aware of the 10% early withdrawal penalty unless you qualify for an exception. Number 2, once the withdrawal is processed, you will receive the net amount after US withholding tax. Deposit this into your Canadian RSP within 60 days to ensure it qualifies as a rollover. Notify your Canadian financial institution that this is a special contribution from a US retirement account. Number 3, when filing your Canadian tax return, report the full amount of the US withdrawal as foreign income. Claim a foreign tax credit for the US taxes withheld, so example 15%, to avoid double taxation. Number 4, report the full amount transferred to your RSP as a deduction on your Canadian tax return to reduce your taxable income. Ensure this does not affect your RSP contribution room by providing documentation that it is a rollover. So here's a quick case study. Let's walk through an example to illustrate the rollover process and how it can save you money on taxes. So as an example, here's a fictitious client, John, a 60-year-old Canadian, spent 10 years working in the US and accumulated $300,000 into his 401k. Now he's back in Canada. John wants to transfer his US retirement savings to his Canadian RSP in a tax-efficient way. So John withdraws the full $300,000 from his 401k. Since he's over 59 and a half years old, he avoids the 10% early withdrawal penalty, but the IRS withholds 15%, so $45,000, leaving him with $255,000. John transfers the $255,000 into his Canadian RSP within 60 days, making it a special contribution. He ensures his Canadian financial institution understands that this is a rollover from a US retirement account and provides the necessary documentation. On his Canadian tax return, John reports the full $300,000 as foreign income, but claims a foreign tax credit for the $45,000 withheld by the IRS. This eliminates most, if not all, of the Canadian tax liability on the withdrawal. John also claims the full $250,000 as an RSP deduction, reducing his taxable income in Canada and deferring tax on these funds until he withdraws them from his RSP in the future. John avoids double taxation by using the foreign tax credit and the RSP deduction. He preserves his RSP contribution room for future contributions as the $255,000 transfer is classified as a rollover. John defers Canadian tax on the US retirement funds until retirement, when he can likely withdraw at a lower tax rate. So, in summary, rolling over your US retirement accounts into a Canadian RSP is a complex but rewarding strategy for Canadians with US retirement savings. By understanding the IRS and the CRA rules, taking advantage of the foreign tax credit and properly structuring the rollover can avoid double taxation, bypass early withdrawal penalties, and preserve your RSP contribution room. So, it's important to always consult with a cross-border tax professional to ensure compliance with both the IRS and the CRA regulations and to optimize your retirement savings strategy.